Now, U.S. debt and deficits are through the roof. Trump's tariff policies flip-flop. Even the Fed's independence is questioned. People are worried. How long can the dollar remain the world currency? Can we still trust U.S. bonds? The market sees through this paper tiger. Cutting rates is politically correct. Hiking rates is economic suicide. So gold becomes the only asymmetric bet that central banks can't print. Thus, gold isn't rising in price, it's rising in trust. When people lose faith in the dollar and U.S. bonds, they turn to gold. It's the market's safe haven instinct at this point. It seems like neither rate cuts nor hikes can fix the economic situation. So why have U.S. stocks started to rebound these past few days? Can this year's rate cut break the September curse for U.S. stocks? And if it does, will it affect gold's rally? Let's first break down a key logic. The benefit mechanisms for gold and U.S. stocks are completely different. They might even be opposites. Right now, the U.S. stock market is rallying on expectations that rate cuts will stimulate the economy. For example, people think lower borrowing costs will boost corporate profits. So tech and consumer stocks are rising. But this kind of rally is buying the rumor. Once the Fed actually cuts rates by 25 basis points on September 17th, it could turn into selling the news. What news? The S&P 500 is at historically high valuations, with a forward PE ratio of 2 to dot. Slowing employment may signal weakening economic momentum. Inflation is still above the Fed's 2% target. The heavy concentration in AI-related tech stocks makes the market vulnerable to swings in that one theme. At the same time, traditional September pressures remain. Pension and mutual funds rebalance their portfolios at retail buying activity decreases, and companies pause buybacks ahead of Q3 earnings reports. Even worse, tariff costs haven't been fully absorbed yet. Trump's tariffs on imports are now filtering through to consumer prices, like furniture and electronics, which will squeeze corporate profits and hurt consumer spending. Take Nvidia as an example. On September 5th, when the weak jobs data came out, you'd think strong rate cut expectations would boost tech stocks, right? But Nvidia fell over 4%, hitting a low since July 1st. Why? Because people suddenly realized rate cuts won't solve Nvidia's core issues. Will demand for AI chips slow down? Can data center construction keep up? Instead, if rate cuts reignite inflation, the Fed might be forced to hike rates early, which would crush tech valuations. But gold is different. Even if U.S. stocks peak and correct, gold can hold up on safe haven demand. Take Europe right now, it's looking risky. Polls in the UK, France, and Germany show far-right or populist parties